The Indian banking sector, it's pretty much the engine of the entire economy, right? But what really makes its stock surge or suddenly just plummet? Well, in the next few minutes, we're going to give you a really simple framework to decode all the forces at play.
I mean, it can feel totally random sometimes, can it? One day bank stocks are soaring, and the next they're in a slump. But here's the thing. It turns out there are actually clear patterns and drivers behind all this movement, and we're about to uncover them together.
To really get a handle on this, I want you to think of the banking sector as the economy's circulatory system. Seriously, it pumps capital, the financial lifeblood to every single business and household. So put simply, a healthy banking sector is the absolute foundation for a healthy economy.
So we're going to approach this using a simple why, what, and when framework. We just covered the why. It's the heart of the economy. Next up, we'll dive into the what, the specific factors that actually drive the sector. And then we'll get to the when, the key times of the year you really need to watch.
Now, this what part really boils down to three key areas. First, you've got the macro forces. These are the big economic currents. Second, policy and regulation. Think of this as the rules of the game. And third, the bank's internal health, which is basically their financial report card.
So first up, let's talk about the big picture. You can think of these large-scale economic trends as powerful ocean currents that just move every single bank, no matter what its size is.
Strong GDP growth, for example, is a major tailwind. A booming economy just means more loans for businesses to expand and for people to buy things. Global sentiment is also key. Positive conditions can attract a whole flood of foreign investment, or FIIs, and that directly boosts stock prices. And finally, you can't ignore the rupee-dollar exchange rate. It has a very real impact, especially for any banks with international dealings.
Okay, so if the big picture economy is kind of like the weather, then policy and regulation, well, they're the traffic signals. These are the rules of the road that every single bank has to navigate.
And the single most important tool here is the repo rate. It's essentially the master switch for all interest rates in the country. The RBI can raise it or lower it, and by doing that, they can either cool down or heat up the entire economy, which makes money cheaper or more expensive for banks.
And this creates a really clear domino effect. I mean, when the RBI cuts the repo rate, your home loan or your car loan EMIs can get cheaper, and that encourages more spending. That surge in loan demand is exactly what the banks want to see. A rate hike, on the other hand, does the complete opposite, slowing everything down.
Now, beyond just interest rates, direct government actions can instantly shift the market. Injecting money into public banks, a process called recapitalization, acts like a shot in the arm for investor confidence. In the same way, big strategic mergers or new lending schemes can fundamentally alter the whole sector's future.
So we've looked at the macro environment and the rules of the game. But how does an individual bank actually measure up? Well, for that, we need to look at its financial report card.
The most talked about metric here is NPAs, or non-performing assets. In really simple terms, these are bad loans. It's money the bank lent out but isn't getting back on time. And this is a major, major red flag for a bank's health.
You can think of a bank's NPAs like its cholesterol levels. High levels are a serious warning sign, clogging up profitability and scaring off investors. Low levels, on the other hand, signal a healthy and well-managed bank.
So beyond NPAs, analysts are tracking a few other vital signs. First, is the bank actually growing its loan book? Second, what's its profit margin on those loans? That's the net interest margin. Third, is it attracting enough deposits to fund all its lending? And finally, does it have a big enough safety cushion, its capital adequacy ratio, to handle any unexpected shocks?
All right, now that we know the what, let's finally look at the when. See, the banking sector has a very distinct rhythm, a calendar of events and seasons that predictably influence how it performs.
The banking year follows this clear rhythm. It kicks off with fresh budgets and tons of activity in April. Then everyone kind of holds their breath for the economically vital monsoon. This is followed by a huge consumer spending surge during the festival season, and it all comes together with the government's budget plans and a final corporate push before March.
For example, the festival season is an absolute blockbuster for retail loans as people buy new homes and cars. Then, right after the union budget in February, government spending plans can totally ignite corporate loan demand. And throughout the entire year, every 2 months, all eyes are on the RBI, where even a tiny hint of lower rates can send the whole sector soaring.
And this just shows you how interconnected everything really is. A good monsoon doesn't just help farmers. It fuels the entire rural economy. And that translates directly to higher loan demand and better repayment rates, which is a huge positive for any bank with a strong rural focus.
So, after looking at all these different pieces, from global economics all the way down to local weather, what's the one thing you really should remember?
The key takeaway is this. It's all about connecting the dots. It's about seeing how the macro trends, the policy decisions, and a bank's own health all interact across a predictable calendar. A really strong banking stock is often just a sign that all these forces are aligning perfectly.
So now you have the framework. The next time the RBI makes a move or the festival season starts to approach, you'll know exactly what it means for the banks. The only question left is, which season will you be watching?